Welcome back to Talk Tickers. Today, we are diving into the latest earnings report from Gaotu Techedu. The numbers just dropped, and let me tell you, this story is a whole lot more complicated than the headlines suggest. All right, let's get right to the heart of it. Gaotu posts a revenue beat, they post an earnings beat, so what happens? The stock tanks 8%. It just doesn't add up, right? Well, that is the central mystery we're going to unpack today. Why on earth did the market hate what looked like a perfectly good quarter? And you can see that reaction right here. I mean, look at that drop. The good news comes out and bam, the stock just falls off a cliff. An 8% drop in a single day. The market wasn't just unimpressed, it was actively selling. And that tells you there's something much deeper going on under the surface. But before we get to why everyone was selling, let's just be really clear about what the company reported. Because to understand the market's reaction, you gotta appreciate just how strong these numbers actually looked on paper. First off, revenue growth was, well, it was really strong. A jump of almost 31% from this time last year. That's some serious momentum, and it shows they are absolutely still bringing in the business. And here's where it gets even more interesting. They didn't just grow, they totally beat Wall Street's expectations. You can see it here. They beat on revenue, and they beat on their earnings per share, losing less money than anybody thought they would. I mean, that's the classic recipe for a stock to pop. But not this time. And this wasn't just a headline beat either. When you dig in and look under the hood, the business itself looks healthier. Gross margins, up. How efficiently they get new customers, better. Deferred revenue, which is basically a promise of future business, is up over 23%. And get this, they slashed their operating loss by more than 60%. The company is, without a doubt, running a much tighter ship. So you can just imagine management on the earnings call, right? They had all this great news in their back pocket. And they definitely came out swinging, telling this really confident story of a company in the middle of a massive tech-powered turnaround. And the founder and CEO, Larry Chen, he put it right out there. He basically said, listen, our use of AI isn't just some buzzword. We're actually using it everywhere, and it's saving us real money. The big message here was loud and clear. We are on a defined path to actually making a profit. They broke down their whole game plan into 3 key pillars. First, that AI integration we just talked about. Second, mixing online with offline learning centers, which, by the way, for the first time, are now over 10% of their revenue. And third, returning cash to shareholders. They finished one huge stock buyback and then immediately announced an even bigger one. It all sounds pretty great, doesn't it? Which, of course, brings us right back to the billion-dollar question. If the quarter was so good and the strategy sounds so solid, what did the market see that it hated so much? Well, the answer is all about what the company said was coming next. This slide just captures the whole conflict perfectly. You've got 2 completely different stories being told at the same time. Management is painting this beautiful picture of the future, talking about AI, efficiency, and profits way down the road. But the market is looking at right now, and it sees a company that is still burning through cash, whose growth is slowing down, and, let's be honest, is still operating in a pretty unpredictable regulatory environment. So let's talk about that first point, cash burn. You know, it's a really simple idea. If you're not profitable yet, cash burn is just how fast you're spending the money you have in the bank to keep the lights on. It's like a countdown clock, and you really don't want it ticking too fast. And for Gaotu, well, that clock is ticking pretty loudly. They burned through more than 660 million RMB this quarter. Now, okay, that's a little bit better than last year, but that is still a massive amount of cash going out the door. And if you're an investor, you have to ask yourself, how long can that really go on for?
But this right here was the real nail in the coffin. The number one reason for that 8% stock drop. It was management's guidance for 2026. Just look at this trend. They went from over 50% growth down to an expected 35%, and now they're telling everyone to expect only about 15% growth next year. For a stock that's supposed to be a growth story, that is like slamming on the brakes. And that single piece of information just wiped out all the good news from the rest of the report.
Okay, so we've laid out the good and the bad, the solid operations versus the scary growth slowdown and cash burn. So what's our take? What should you be watching for? Let's get into our official call. So here's what we think is going to happen. Next quarter, they'll probably hit their revenue target, sure. But that all-important cash flow, it's going to stay negative. That means the stock is likely going to be stuck, trapped in a tug-of-war between the bulls who believe in the turnaround and the bears who see the slowdown. The one thing that could break that tie, their path to profitability in 2026. If they even hint that they might slip on that goal, watch out below. And for all those reasons, our rating on Gaotu is market perform. The thesis is simple. All the good stuff, the efficiency gains, the AI integration, is already baked into the stock price, and it is being completely canceled out by the bad stuff, the slowing growth and the cash burn. Right now, the risk and the reward just feel balanced. There's no clear reason for it to soar and no clear reason for it to crash. It's a wait-and-see story.
And as always, a final and very important reminder, this analysis is for informational purposes only. This is not financial advice.